Our main focus point on InvestTalk today was about the Fed meeting coming up on Wednesday and whether stagflation is going to put the Fed into a bind. And the reality is yes, to a degree, but it's pretty clear to me how they will come out. So the Fed is looking at obviously inflation and growth in the economy. The last time they met, everything was pretty good. Unemployment rate was low and you had inflation continuing to decelerate. Now they went on pause because it's still above their target, right? Inflation's still above their target, around 3%, depending on what measure you're looking at, 2.5%, 3%. But they said at some point we might cut. But in this new environment, you have the government implementing tariffs. That obviously is a hit to growth. It's a hit to consumer sentiment and business sentiment. And then you also have the inflation side with tariffs, and that's staying relatively elevated. So what happens if the consumer or the economy continues to accelerate and inflation starts to accelerate? That's called stagflation. Now in the early 80s, what Volcker did was raise rates dramatically from the high single digits to the mid to high teens. Now he could do that because the debt of the government was very low, 30% of debt to GDP, not a big deal. But you see as of now, we're at a debt to GDP around 130. And so when rates go up, you now have $1 trillion plus interest bill. And so it's pretty clear that they're more likely to support the broader economy and allow inflation to continue to run hot. And when that happens, that changes the dynamics within the broader markets. So that's where we're at right now. There's an important decision coming up with QT, whether that's going to be ended or they're going to cut rates or both in the coming meetings.